welcome to this edition of Closing Trades. And the weakness in the market continues. We're down a good 1% for the index as we speak right now. No respite when it comes to the market breadth. In fact, it's even worse when it comes to the broader end of the market. You've got a count of 219 standing to the declines within the F&O band, which is about 13 names standing to the greens. And it's just a handful of them. In fact, other than Britannia, there's not a single stock which is higher than even over 0.5% right now. There's Britannia up over 1%, and then there's Tata Consumer, Bharti, TCS, which are just about a smidge in the green. The big weakness today is in the metals pack sectorally. So there's Tata Steel, there's JSW, these are all names, Hindalco as well, which are down and out. Trend is taking a whack right now, 51.84 on the stock as we speak right now. Bajaj Finance has taken a tumble of about almost 2.5%. There's Hero MotoCorp, Tata Motors, there's Reliance Industries down 1.6%, M&M is down, L&T is well lower. It's pretty much all, red across the screen. Even sectorally, there's not one single sector which is in the green as we speak right now. But let's analyze and dissect the market further. We've got Kunal Bothra, Naresh Mirani and Deepak Shenoy joining in to do exactly that. Kunal, let me come to you first because while at an index level, we may be down just about 200 points, but the internals are more scary right now, given the faction of the market which is in the red and the kind of quantum of fall that you're seeing, and the gainers are just about, barely latching on.
Yeah, Aisha, and I think that's been the nature of the markets over the last 2-3 months, where we've seen the whenever we've seen the index dropping down by say 0.5% to 1% range, we've seen the market breadth to be a lot more deteriorating. And today, I think today's day is also no exception to that. We are also seeing some rise in the India VIX. I think that could be a bit uncanny because we generally expect that after such kind of a last 1 week, 1.5 odd week, where the line of the slow of events, once that is out, the India VIX ideally has to cool off and come back to that 13 or sub 13 mark. Now with this rise in India VIX, I would probably believe that this could be an indication that the volatility may just about start to increase for the indices. So far the comforting point for the markets is that we are holding on to the 20 DMA for the index, which is around under 23,250 odd mark on the spot levels. This is exactly that zone where just post the budget, the index bounced off, and from there we saw another 400 to 500 points rally. So we look at 23,250 as a critical support, and till the time the index trades above those levels, we can continue to hold on to long positions.
Right. Good afternoon, Naresh. Actually, if you look at the markets, the broader markets, no respite coming in for the broader markets, and in broader markets, a lot of names. Actually, we thought that given the fact that we had this sharp correction in the broader markets, some of the stocks would have actually got re-rated. The valuations would have looked attractive. Doesn't look like that, is it?
So for now, the broader markets have been hit today a lot more. We are seeing a 2.5%, 3% move downtick across the board. The small cap index has also taken a hit. And we are in this drifting zone wherein every bounce back, we continue to face resistances on the broader markets. And this is a phase where we start making a bottoming out formation. We saw a decent bit of recovery on the Nifty, say from 22,800 to 23,600, 800 levels. In the same period, we saw a bounce back in the small cap indices also. Now we need to get into a consolidation phase where we start making a range. So for now, 23,000, 23,200 and 23,800 on the Nifty. Similarly, the recent lows should hold up on the small cap index. And post this consolidation, we get to know whether the next move is on the upside or we make a fresh breakdown with global markets.
Right. Deepak, hi, afternoon. How would you describe this market? Because, like I was chatting with Kunal earlier this morning, that all the indicators are pointing towards an upside, but that clearly seems to be eluding us. At least good news from the budget, good news from the Delhi state election verdict as well. Wonder what the markets are waiting for. And of course, a cut from the RBI too.
Yeah, I think Aisha, fundamentally, even the earnings are not as bad as one would have put them. We were actually quite positively surprised. There were a lot of results that have come. If you look at some of the companies, and we own some of them, of course, M&M and so on, have been quite good in that respect. However, I think there is an overall sentiment at two levels. One is that the rupee has fallen quite considerably, and therefore impacts of it downstream may be more if it continues to remain at these levels. The second one is the fact that the US has started talking tariffs again, And that is a blow to world trade in a lot of ways. It's going to hurt the US a lot as well. We don't, I think, appreciate the enormity of it yet, because I think there's a lot of, jingoism going around about how this is actually beneficial X, Y, and Z. But it's beneficial to all countries in the long term. Countries like India, which are anyway trying to be more self-sufficient. But in the short term, it's going to be a bit of a. It creates a lot of downside pressure, and downside pressure, there are lots of bankruptcies. So you don't want that in the short term, but of course you have to believe that the system gets better in the long term. However, as much as this happens, it's going to be another 2 or 3 weeks of this in terms of policy uncertainty. After that, the fundamentals will start having to play out. This is a great time for picking stocks, especially when they fall unreasonably, sometimes much more than their fundamentals indicate. That's the only time you get to buy stocks cheap. So I don't necessarily think this is a bad thing for people who have more than a few years to invest.
Right, Deepak. So, like the way you mentioned that it's time to pick stocks that have fallen more than warranted, fundamentals are strong. Any stocks or maybe sectors that you can point out these stocks from?
So I mean, I'll give you an example. We own LIC, and LIC had a pretty good result in terms of profits, 11,000 crores in profit after tax. One of their highest ever, if you don't consider the Q4. Q4 is unusually large because of the way they allocate profits from participating policies. But in Q1, Q2, Q3s, this is one of the largest profit numbers since they have been listed. They're listing at a P they're probably at a P that is less than 10 1 year forward. Reasonable growth in terms of profits also, because they will take more profit share from policyholder profits. Essentially, they were half of what other insurance companies would be taking at 5% of profits. They're slowly increasing it to 10% of profits, which is what HDFC Life and all of the other companies generally take. So, just that is going to provide some layer. And then the fact that ULIPs are now back into some kind of they were disadvantaged a few years back from a tax perspective. Now they're not so much. So there is that is coming back as well. I think these are factors that, a relatively less than 10 PE stock, you're seeing that also getting hammered. I think that is, one sign. But apart from that, you look at the manufacturing industry in general, a lot of stocks have been down about 30-40%. Even in the auto sector, auto ancillary sector, we're seeing some stocks down tremendously, although they're showing some growth. There are some relatively overvalued sectors growing strongly and still down, like semiconductors and so on. So these are areas where we're looking at.
Interesting. So, Deepak, I just want to get back to LIC. So, what do you do then? Just book out, exit on a loss?
Well, if you want more money right now, sure, because that's the way the market is going to be. If you need the money now, and this is the only stock you have invested in, then you might want to do that. But typically, you would have a portfolio. You want to eliminate, if you need money, also you want to eliminate stocks that are relatively more expensive for what they are. But I would say keep in mind in a longer time frame, the solvency ratios of this company are at 2.07. The requirement is 1.5. Essentially, they have a lot more money sitting on as their on their balance sheet than they should, and they should therefore start announcing dividends on this as they collect more and more money as it goes forward. So if you have a long-term horizon, 3-4 years plus, then yes, I think this stock is definitely worth it. We're biased because we own the stock, but then I would say that's the way to go forward. I would say sell only if you find better opportunities or if you need the money right now. But I would say this is an important part of our portfolio. I don't see any reason to sell it at a loss right now. But everybody's situation is different, so I don't want to give generic advice to anybody else.
But that's that on LIC. Let's get an exclusive, in fact, from the insurance space. And, the government, as we understand, is progressing with a proposal to put into operation the Golden Hour program that actually plans to provide financial assistance for medical treatment of road accident cases. Now, the Road Transport Ministry has written to Chief Secretaries of States recommending a penalty on owners of those vehicles that are lacking insurance. Anurag Shah, my colleague, is here with exclusive details.
Transport Ministry has returned to Chief Secretaries of all states for stricter implementation on uninsured vehicle. As we know that 50% of vehicle running on roads are uninsured, and as per Motor Vehicle Act, any vehicle running on road should have a mandatory third-party insurance. And the trigger for directive by MORTH to state Chief Secretaries is the Golden Hour treatment scheme, which is launched on the pilot basis, but government is planning to launch this scheme on pan-India. This scheme will provide cashless treatment of 1.5 lakh rupees or 7 days of hospitalization, whichever is less, for road accident victims. But general insurance companies has agreed to contribute to this fund only for insured vehicle. So for uninsured vehicle, government will bear the cost. So now government intend to reduce the number of uninsured vehicle, because for insured vehicle the fund will be given by the insurance companies only. So going ahead, we'll see that e-challan will be issued by transport department across the state, because now government is determined to reduce the number of uninsured vehicle running on the roads. And as per Motor Vehicle Act, it's a mandatory to have a insurance, third-party insurance. So this is the directive from MORTH to all state chief secretaries.
All right, thank you so much for that, Anurag, for getting us those exclusive details, and also a crucial one when you talk about it. But let me move on. Let's talk about the events, right? Because most of these event risks seem to have surpassed when you talk about the markets, be it Trump taking over, be it also your budget, be it the Delhi elections, be it the RBI MPC meet outcome. This week, a big event that's lined up is the PM's visit to the United States. You have the oil minister statement saying that the PM will be having a bilateral meeting with President Trump. It's going to be crucial, natural for energy security to be part of the discussion, is what the oil minister is saying. And also they're saying that they are expecting very big developments when you talk about the energy part of it. But let me get your view, Mr. Shenoy, given the fact that, yes, you have this big visit from the Prime Minister to the United States, and that I think is going to be a big event to watch out for, given the fact that there's a Trump rhetoric on tariffs. He's called time and again India a tariff king. We've tried to move somewhere on the tariff front in the budget. What's your sense? What should one expect when you talk about this big meeting? Which are the sectors one should watch out for and place themselves or strategize for this?
So to be fair, first thing, we haven't done anything meaningful on tariffs. So they've just moved away from the duty to the AIDC, which is the agriculture import cess. I don't think, therefore, that we've actually done anything meaningful. Of course, there is no reason to preempt doing anything. You meet and then they make demands, and then you say, okay, well, this sounds right, correct, this sounds not so correct. For instance, importing a Harley Davidson motorcycle at even after a 0% duty, that thing will still cost you like 7 or 8 lakhs. It's not going to be meaningfully bad for India. We don't, our roads don't really like those kind of vehicles as much, and they won't sell at those price points anyway. So you might as well kind of reduce those duties, but it has to be a bilateral negotiation rather than us saying, oh, let's reduce it anyway and let's figure out what they want next. So there is going to be a negotiation on tariffs. We have always had tariffs. America has always had tariffs up till maybe 20 or 25 years ago. America has been America in the 1700s and 1800s, when they were developing, had 40 to 50% tariffs. So every country, when it's developing, has to have tariffs. China doesn't have tariffs, but they don't allow you inside by non-trade barriers, non-tariff barriers. So they don't allow you to do certain things. A Twitter can't exist there. They have rules that says, well, you just can't. So you have to use a Chinese-made product. So they have other ways to deter foreign companies from investing or doing things there. So I think these things will be discussed in some meaningful format. We're really small in that thing. We should at some point stand our ground. There were some reasons for these tariffs, and we want our industry to develop. So some of these tariffs make sense. Some of them are ridiculous and they don't make sense. And some of our rules are also convoluted. So I hope we kind of use this opportunity to reduce those. But I would assume that this event is of significance only because it's happening now. To me, a lot of events have already happened. We've had a rate cut, election results. We had the budget go that has come and gone. Relatively, this will be a smaller element of it all, and I don't expect it to be majorly positive. We should have expected tariffs right from the day they started talking about tariffs, and I'm sure we're going to get some of them regardless.
All right, then on that note, we'll slip into a break on this edition of Closing Trades. Markets over there on the near the day's lowest point. When we come back, we'll talk more on markets and stocks. Don't go anywhere. Live from the Motilal Oswal studio, and let's talk about markets then. Given the fact that we are pretty weak in trade today, the advanced decline ratio, no despite respite coming on that particular front. You have the broader markets that are under pressure in trade today. Deepak, let me come to you and let me get your take coming on the consumption pack. Given the fact that you thought that post the budget, that's a place that you can actually go ahead and invest or look at least the consumer discretionary space. Do you think a week after the budget, that sort of a thesis holds?
Well, it's a week after the budget, like you said, and it's not even like this saving has come through right now. So, and I think what we call the consumption pack is this FMCG stuff. I mean, how many more noodles will you consume and how many more toothpaste will you buy? I think the durables is where the action will be going forward. It may not necessarily be in this stuff that we call consumption, which is typically smaller end FMCG or things like that. It's not going to be staples. It's going to be durables that I think takes a bigger part of the savings going forward. I don't think we should focus on some of the more expensive FMCG companies also, because they are just normalizing in terms of their long-term PE ratios, which should be at 30 to 35 to 40 times at best, not at the 60, 70, 80 times that they used to be. Now some of them have come down to the 50 time number. But when you have a set of companies that grow only at maybe 5 or 10%, why would you pay a 50 times earnings even for them, regardless of whether they're MNC or not MNC or so on? So I think this is a normalized correction for them. However, some of the durables players, they had also gotten valued at with maybe a 40, 45, 50 times. They're down to 30, 35 times, and maybe they have a greater potential to grow given where we are. The 1,10,000 rupees saving at the higher end in the tax budget translates to about nearly 9 or 10,000 rupees a month, which is the EMI for a small car, so or even a mid-sized car. So I think that's where the action is going to move to, not to where what we call consumption, which is consumer staples really.
Oh yeah, absolutely. Considering that they're, price inelastic in any case. But Deepak, tell me, what's the strategy so far? I mean, what sort of cash levels are you recommending to sit on across your clients?
So different strategies here, Aisha. I think if you have a momentum kind of a portfolio, which we do, it has some natural cash because the momentum is not much, and therefore cash levels go much higher simply because it responds to the market, and therefore your cash levels will be high. In other cases, in our fundamental portfolios, we have very little cash, though we have generated some cash to move around. There were positions earlier that were more cash oriented, maybe a month or two ago, and then now that has come back in, so we're able to kind of pick up more stocks. We've been waiting for results to finish, and now they're nearly done. So we're we're able to kind of reshuffle the portfolios a little bit. So I don't think cash level should be too high at this point. You can actually go back in meaningfully over for a 4 or 5 year horizon from here. But I think the focus has shifted from some of the more expensive small or mid caps to a slightly larger proportion of large caps, slightly different makeup of mid and small caps. But overall, our investment themes in a stronger India going forward, they continue to remain in that. I'm not really changing core investment thesis here. I'm just moving stocks to based on results to what may make more sense for us. I still think a lot of focus, a lot of good things will happen in the defense, in manufacturing, even in the consumer durables sector where we have a few investments, and in financialization where I think growth continues unabated.
But is private banks the way to play it?
Private banks are one area. I think they're more they're cheaper than perhaps some of the other parts of the market. But the larger private sector banks, some of them actually provide some potential to grow. And even some of the NBFCs now, I think there's some more potential going forward. Because basically, the stronger NBFCs will probably win, given that there's a lot of pressure on smaller ones in terms of NPAs, asset quality, and growth. So, kind of using this as a moment to kind of reshuffle that part of the portfolio. But financialization goes into other areas as well: market players, market infrastructure participants, people who do the backbone of things like mutual funds or the stockbroking industry. I think those will also continue to do well going forward. So it's not just the banks that we'll focus on.
Makes sense. Deepak, great to have you on the show. Thanks as always for your time and insights.
Thanks, Aisha.
Okay, well, Maharashtra, it seems, is likely to take a bold green leap, and the state government is aiming to phase out all petrol and diesel-run vehicles in public transport within 5 years, as per our channel sources. In fact, Sameer Dikshit is here to tell us more about what he's picking up from his sources right now.
Each and every vehicle put in public transport use along with the state-run vehicles will shift to either EV or the alternative fuel-run vehicle, and that's the big policy initiative. It is likely to be adopted by Maharashtra state government. The state government, Maharashtra state government, is aiming to completely shift to EV, the electric vehicle, or even the alternative fuel-based vehicle, that is CNG or the hybrid or flex fuel-based vehicles by year 2030. And for this, Maharashtra state government has already done the key consultation with the stakeholders, and the policy is likely to be introduced very soon. In addition to this, the state government has also constituted a 7-member committee that will provide the key suggestions to the state government that how the Mumbai area, MMR area, can be decongested by discouraging the petrol and diesel vehicles which are being used by the private owners. And also, the state government is looking to make such policy that it will not allow any user to buy a new vehicle if not having a valid parking space. So with these multiple steps, Maharashtra state government is looking to address the issue of pollution. Not just pollution, the state government is also looking to decongest the popular and the very congested cities like Mumbai. And for this purpose, these policy initiatives are going to be adopted and to be introduced very soon.
All right, thank you so much for that, Sameer, for getting us those updates. But let me actually get the closing trades pick coming in from our experts, Kunal. Let me first ask you, what's your closing trade?
I'll go with the stock which I've been recommending over the last couple of days, and that's Kotak Bank. A very interesting chart, the stock confirming a breakout, and even in this kind of a market, the stock is holding its head above the water, still trading with a positive bias, and then I think on the verge of breakout of the Friday swing high, so looks attractive.
All right, so that is Kotak Mahindra Bank coming in for Kunal. Naresh, what about you?
So that would be a bounce back trade on SBI. The stock has corrected a lot. 720, 730 is a support for the last 1 year. So expecting a bounce back from here, keeping a stop loss at 730 and expecting a bounce towards 770 levels in the short term.
Looks like it is banks all the way coming in for both of our experts, one from the private sector bank, the other one from PSU. But nevertheless, we will track all of those movements on the other side of the break. Don't go anywhere.
I will take you to Paris.
Paris नहीं, Paris. तुम्हारा pronunciation भी ना, तुम्हारे इरादे की तरह.
We are placed at this point in time, given the fact that we are seeing a tad bit of recovery coming in on Indian markets from the day's lowest point, is the broader markets that continue to weigh heavy. Some commentary in the bottom of the screen coming in from the oil secretary. Remember that this is supposed to be seen in the light of the fact that you have the Prime Minister that will be visiting the United States in order for a bilateral talk. So you have the oil secretary that is saying now that the Indian oil companies, including GAIL, IOC, BPCL, are looking at buying US LNG, and the companies are open to buy a stake in the US LNG project. So very crucial commentary coming in. We also have Sunil Subramanian, who is joining us on the show right now. A very good afternoon to you, Sunil. And a lot has transpired over the last 15 odd days in the markets. You have the Trump taking oath, almost a month. Trump taking oath, you have the budget, you also have the Federal Reserve meet, RBI meet as well. A lot has transpired, and now this week we are all waiting for that crucial meet between the Prime Minister and the US President. And there's a lot is talked about it, given the fact that we are talking about there could be some defense tie-ups, energy tie-ups, and some respite coming in for the pharma sector. What's your view? Which sectors should you watch out for in light of this?
So obviously, right, and you also have to mention the fact that so far Trump has not said anything negative about India or tariffs on India specifically, and also the fact that India has happily accepted the illegal immigrants back. So I think we are pulling out all stops not to have any hurdles. I think the budget also, some tariffs were eased, basically putting one on Harley Davidson motorcycles, which was a sticking point during Trump's first term. So I think we are paving the road for a smoother relationship and hopefully extract some benefit on the tariffs that other countries like Canada, Mexico, Europe, as well as China are going to face. So hopefully the fact that Mr. Modi has been so quickly invited is a positive sign. And naturally, from a concessions perspective, I would still back the IT, because I think that's one thing very clear, that America cannot substitute Indian IT engineers yet, because that level of skill, and that's a high-end jobs. And Trump's focus is more in terms of the steel, the manufacturing, the low-end jobs where mass employment in the US, can be created. So I think IT continues to be something that I think India will walk away with some wins there, because it's in services. So there's not so much of that we are not putting any tariffs, or we are not putting any making that more expensive for the US in any way. So I think IT continues to remain something where India can extract value because of a proven thing. And with the AI boom now coming in and America trying to go ahead on that front, I think Indian companies, especially mid-cap and small-cap IT companies, have a huge role to play in the IT consulting space. So overall, I think IT is something that should benefit from whatever aspect of Trumponomics is at play. Similarly on pharma, because China is a huge API producer, and I think tariffs on China will represent opportunity for India to rapidly scale up and do. So I think to that extent, pharma also, and both IT and pharma will benefit from any currency depreciation also, which is an added advantage to that sector. So from purely the external orientation part, I would think that these are two sectors to focus on. But if you then look at from a slightly deeper perspective, right, we also have to remember that problem for India has been its consumption, and the budget and the RBI rate cuts have given a boost to consumption. So that's a pure domestic play, and I think so this Trumponomics will not affect consumption. So I remain focused that discretionary consumption should ultimately come out a winner after this current set of volatility eases.
Okay, Mr. Subramaniam, this is Snehi also joining in. While you gave us your perspective on the entire IT and pharma space, also help us understand how this entire Trumponomics, like you put it, is going to affect the entire metal space, because we've heard this blanket ban coming in on any imports of metal to US from any country in the world. There's a huge tariff on that as well. Today, our metal index is down 2.5%, Nifty metal. Give us a sense of what you are seeing for the metal index in the metal space going forward, because on one hand, you have gold that's doing its own thing. You have the dollar-rupee trade that's affecting all the commodities as well. So give us your sense on where metals you think are headed now.
So I think that from a metals perspective, we have to look at it the fact that India gets impacted because the prices of metal is fixed in the London Metal Exchange, but the demand and supply are very local. So from India's perspective, the steel and the ferrous metals, the demand should be good because construction and real estate and capex, whether it's government capex or private capex, all of them need steel, need copper, need aluminum. So I think there's a problem on the demand side. Now the prices, the share market prices are getting affected because of the Trump factor. But I still like to believe that Trump uses tariffs as a bargaining tool rather than as an actual implementer. His track record in the few days, you've seen, right? He's put tariffs, they made some concessions, he's pulled them back. So his idea is to basically extract as much value. So I believe that the immediate panic reaction of the market to this tariff will settle right once the reality comes through in a few days on how the exporters of steel and metals to America, how do they respond to this? So I think this is a panic reaction. And I would say that while it's still not yet time to go and buy the metals back, I would say I'd see that this will reverse fairly soon from the lows that it's come up back again once the reality of countermeasures of the exporters of metals come into play. So I think it's an interesting time to watch. And I would still say that it's just time to wait on the sidelines and observe the sector rather than commit money into the sector at this point in time. But I believe that the bad news is not going to be continuing because, like I said, ultimately, Trump is a very good, hard negotiating businessman, and he will use this to extract better value for America. So that's how this should play out. And so it's better to wait and see how that pans out.
Right, a very hard negotiator. Wait on the sidelines, watch out how things actually transpire for metal sector. Is that what the charts are also telling you, Kunal, when you talk about the metal space?
I think it's a good time to nibble into these metal stocks. Now, I understand that there's been some news flow which has been negative into these metal counters. But then when you look at this, as a price trend, we look at that many of these metal stocks have formed a decent bottom for themselves. You've seen Tata Steel coming back to that 120 mark, sub 120 levels. SAIL was a stock which is just about grinding on the 100 levels very recently. Jindal Steel, you've seen JSW Steel, etc. These stocks have made a formidable comeback for themselves in the last 2-3 weeks, and that generally is a first indication that maybe the worst could be behind for many of these metal stocks. What's also aiding to this move is the kind of volume sink we've seen into the price trends for many of these names. So yes, of course, today's data would probably indicate that the volumes is pretty much on the higher side. But then if there is no follow through for the next 2-3 consecutive days, that would indicate that this could just be an event day sell off, which is a natural course for stocks to react on the back of such kind of a big news flow. I believe largely the trend for many of these metal stocks is positive, and I think this dip which is happening into these names could be a good buying opportunity.
Okay, let's shift focus from metals to banking now. Naresh, I want to get your view in on the entire banking space because you have the private banks as well as PSU banks. Both of them have been lagging away. What are both of these indices looking like to you on the charts? Nifty Bank and Nifty PSU banks both.
So both of them look interesting for the fact we are seeing some of the names actually show momentum. So you have Kotak Bank trying to make a new 52-week high. We've seen HDFC Bank make that base around 1630, 1650 and slowly come back. SBI is at closer to the 10-12 month lows and trying to make a comeback. So risk reward wise, that is also placed well. And the ones which had fallen have actually fallen quite a lot. So for example, an Axis Bank has fallen from 1300, 1350 all the way down to 1000 odd levels. Or an IndusInd Bank from 1300, 1600 down to 1000. So there has been, even in the smaller PSU banks, there has been a 30-40% correction. So overall, in some cases, the correction has been very large. In some cases, we are seeing fresh breakouts. So structurally, both the sides, there could be a trade.
Right, that's about the banking space coming in. Actually, Sunil, I wanted to come to you and talk about the banking space in particular, given the fact that this one is where the valuation seems to be of comfort right now. Correct me if I'm wrong. And if it is so, then which one do you think one should look at? Private sector bank or the PSU bank? Because when you talk about the earnings front, PSU banking names have actually done well. The street has rewarded most of these companies on back of their earnings.
So I would say that the key difference between private sector and public sector, say that the number of good quality private sector banks is more than the number of good quality public sector banks. This is this is a result of their natural way of structuring and everything, right? So there are a handful of public sector banks which are very, very good, and a whole bunch of them are not so good. But I would say I would expand that basket of good quality banks in the private sector to be a little bit more. That's number one. Number two is the private sector is largely focused on the retail aspect of the business, whereas the public sector banks still rely on business loans to small and medium enterprises, capital goods, and all of that. So immediately on the short term, if you see that there is some pressure on the NPAs at the very retail end, unsecured loans, and those kind of loans at the end. So those private sector banks are a little more exposed to that unsecured bit, will probably show an increase in their NPAs, and there will be some pressure on the NIMs also there. Public sector banks are not showing that because they've not got so exposed to retail. But the problem for them is business growth, because private sector capex is yet to pick up. So for them to lend a lot to small and medium enterprises, it depends on the capital goods. Now I'm bullish that over the next 6, 9, 12 months, with the consumption boom, capacity utilization improving, the capex cycle will start, and then public sector banks should benefit. So if you have a slightly longer term view, right, public sector, good quality public sector banks are a good buy because they're going to benefit from that. And the second is that all this giveaway, a lot of the money, about 100,000 crores we talked about as the tax giveaway, let's say roughly 60,000 will go into consumption and 40,000 to savings. In that savings, people still rely on public sector bank deposits. So I see that PSBs will face less of a challenge on some deposit mobilization, because part of this, people still rely on the guaranteed return that they get from the banks, and they have a much better CASA, branch network and all of that to benefit from that. So from a medium-term perspective, I would say public sector banks, both from these aspects, are a good buy. But for me, the quality of private sector banks, right, I think that is the lower NBFCs and us who are going to get more hit in the unsecured lending. I think good quality private sector banks have good risk management practices, and the valuation gives me greater comfort there. So from a slightly shorter term pick, private sector banks are a better pick for me because of the valuation comfort. But from a medium term, both the CASA flow and the FD flows, plus the pickup of private sector corporate capex over a period of time, makes it the public sector banks will result in greater business and expanding their NIMs over that time. So I think a blended mix of both, depending on your outlook, would be the way to go. But overall, yes, I'm bullish on that. And one final point I want to make is that the 100,000 crore giveaway, while part is going to go to consumption, that's going to benefit private sector banks more because they are more into the retail EMI-based lending, right? But at the same time, they also benefit from the whole shift into the savings. So insurance companies and mutual fund banks are big, private sector banks are big distributors. In the public sector, you have State Bank, Canara Bank, and one or two others who are, but a lot of the private sector banks, whether it's ICICI, HDFC, Axis, you name it, Kotak, are all very big on the distribution side. So they should get a fair share of fee-based income from selling insurance and mutual fund products, right? So I think to that extent, they will get a boost to their income from the fee-based side. So that's why I believe from a shorter term, private sector, good quality banks are a better pick from a shorter term. But if you have a medium-term perspective, then PSUs can also aid your wealth creation.
That's the outlook coming in on private versus PSU banks, and where Mr. Subramaniam's preference lies, largely, if you could call it that. But while we are talking about the consumption space, Mr. Subramaniam also touched upon that space. We have a very important company coming out with its numbers just in a few hours from now. That's Nykaa, one of the last consumption plays to come out with its numbers for Q3 earnings season. And here's what we're expecting when it comes to Nykaa on the consolidated basis. Revenue is expected to come in at 2,270 crores versus 1,788 crores, which is up 27% on a year-on-year basis. EBITDA is also expected to grow very sharply, rather 42%, seen at 140 crores versus just 98.7 crores this time last year. Net profit is expected to double, or in fact slightly more than double, if you could call it that, because coming in at 36 crores compared to 16.2 crores this time last year. Margins are also expected to inch up incrementally at 6.2% compared to 5.5%. Now, remember when the company gave their update, they were very positive on the net revenue. They said that net revenue growth is likely to be higher than mid-20s. That's what we are also expecting. Rather, we're expecting a 27% growth on that front. GMV growth for beauty vertical to be in low 30s, and fashion to deliver net revenue growth of around 20%, while the net sales value growth is likely to be around low to mid-teens. What we are expecting in exact numbers, the GMV and revenue growth of 27% each. When it comes to the beauty and personal care, the BPC segment, that GMV we're expecting at 32% and revenue at 38%. For fashion, the GMV, which is the gross merchandise value, of course, that we're expecting just at a 1% growth. So it's actually the fashion numbers that could weigh down on the overall Nykaa's Q3 earnings. And for fashion, we're expecting revenue growth of 21%. BPC should post strong performance driven by customer acquisitions as well as tailwinds from the festive period. Largely, this is what we're expecting. What's going to be key to watch out for when the earnings do come out is the BPC advertising revenue and EBITDA margin improvement, new customer addition for BPC, and lastly for fashion, the NSV growth and the loss reduction. These are going to be some important metrics to watch out for. So keep a close eye on Nykaa's Q3 numbers. They'll be out in just a few hours from now.
Right, absolutely, Snehi. But I hope you've actually kept an eye out on the Nykaa Pink sale. Have you?
Pink sale, Cheryl. Every time there is a sale, my eyes are on the sale. Don't worry.
But the point is, have you purchased some and contributing to all of that or no?
Well, not this quarter. My contribution is not going to be in this quarter, but over the past quarters, I think Nykaa would be very thankful for me.
Yeah,
to
absolutely.
have me as a
But you know,
customer.
Sunil, that's my entire debate that I keep having, you know, within my mind that, you know, how is it that you'll end up buying quarter after quarter from these places, be it your consumption theme, be it all of these plays, you go to a store, you buy in bulk, and then, you know, quarter after quarter, how do you, as a layman, as a consumer myself, I want to understand the rationale when you look at these companies. What is it that one should actually look out for?
Okay, see, if you look at it from as a, are you asking me as a market share or as a share market perspective or as a consumer perspective?
Consumer perspective, because I know that most of my viewers also are watching this as consumer in a consumer perspective more than, you know, when they are taking a call to buy into a counter, they are also looking at these counters as a part of being a consumer, right? When you are looking at Mahindra, you're looking at Maruti, you're looking at all these companies, you also look at them in the consumer perspective.
So I think as a consumer, what's changed is one is that basically the consumer's age has come down. The result of this age coming down is that you're much more, I would say, short-term in your outlook. You're willing to change, try out new products, keep flipping products a lot. Now, whether it's cars or it's iPhones or it's fashion, right? You try something, you don't like it, you go back and you try. So you're not willing to stay patient with the product for long. So you're triggering that. So I think the whole quick commerce indicates that, right? Your quickness, you want immediate action, immediate delivery. And 3 months you not like the product, if somebody comes with a new, you are more than willing. So I think the ability to take a risk with a new product, the lack of a longer term perspective in the mind saying, oh, I didn't like this, let me change. And somebody comes with a better offer, I will easily flip. So I think it's a huge mentality shift in consumers, which is what is driving all of these kind of businesses. And while one can argue that, you know, it's not socially good, but I think from a business perspective, I think this is how Western economies are, right? And we are just now aping them in terms of this buying behavior. And I think from as a market participant, as a consumer company owner, right, I think is welcome, right? As long as I want every new product to be tried by a set of initial routers there. So I think that's good from an economy perspective. But as a consumer, you can't change them the way they think. They are exposed to so much more information thanks to Google and Insta and WhatsApp, and people are going to keep trying out new things. And I think that's where the product life cycles are going to be much shorter. We'll keep getting newer products, and that company which can keep the pipeline full with new, interesting, innovative products will continuously walk away with market share.
Right, point taken. Thank you so much for that, actually, Sunil, for enlightening all of us to understand all of it. But, you know, one of these entire sectors that have been focused of late has been the defense space. And right now, while I speak, India's defense might is on display as Bengaluru kicks off the Asia's biggest aerospace extravaganza. You have the 5-day spectacular performance spectacular promises to be a thrilling showcase of the latest advancements in the aerospace technology. And for the first time in the history, the Aero India 2025 will witness the participation of two of the world's most advanced 5th generation fighter aircraft, that is the Russian Sukhoi 57 and the US F-35. Times Network's Deepak is here to get us all the details from on the ground. Deepak, over to you.
Su-57, which is of course making its debut at Aero India 2025. The fifth generation aircraft, of course, from Russia is a one of its kind aircraft. It's a multi-role aircraft, stealth aircraft, and something that India, of course, has been on the lookout for. Right next to it, of course, is the Sukhoi 30. This is something that India has had for several years now, but what it's really looking out for is an aircraft of the capabilities of the Su-57. What's even more unique is the fact that this time around, there is also the F-35. F-35s of the US, of course, made its debut in 2023. This time the Russians bringing their stealth aircraft to the fore as well. Now, what's very important and why I'm emphasizing on the fifth generation and stealth aircraft is the fact that China has, of course, its own fifth generation aircraft parked at air bases very close to India. And India, of course, has been looking out at an opportunity to get hold of their own fifth generation aircraft. So, on one hand, the defense minister has been emphasizing on the importance of India manufacturing its own very soon. But until then, will they really go for the F-35 or the Sukhoi 57? That remains to be seen. Apart from all the business deals that's at play for the people visiting Aero India 2025, they will, of course, bear witness for the very first time the Sukhoi 57 taking to the skies.
एरो इंडिया 2025 जब सिर्फ मेरे लिए ही नहीं बल्कि पूरे भारत के लिए एक बहुत बड़ा क्षण है।
Indeed, it is in Bangalore as we speak. But on that note, let's just focus once again to the markets. We have a couple of minutes left before we wind up for the day. Kunal, on that note, share with us your BTST trades. What are you liking?
Yeah, two buy calls. The first one is on Berger Paints. That's a chart which is starting to look attractive, at least a lot more relatively stable and strong with respect to its other peers. So would recommend a buy with a target of 500. Stop loss could be kept at 470. And the second is upon Uno Minda. That's a chart which has made a very strong comeback, almost like a V-shaped recovery into the stock in the last 2 weeks. Would look out for targets in the range of 1120. Stop loss at 1040.
Okay, Kunal, those are your trades, Berger and Uno Minda. Naresh, coming to you. What's looking good for tomorrow?
So first is one SBI near the support, stop loss at 730, target price of 750. Second is the sell on CG Power with the stop loss at 595 and a target price of 565.
A buy and a sell idea coming from Naresh then. Let me get your closing ideas then, Sunil. What should viewers do given the fact that you've not seen a respite when you talk about the FII selling of late? What should one watch out for given the fact that there are a lot of other moving factors right now?
So I think two things here. One is FII selling is across emerging markets because of Trump's, whatever Trumponomics as I coined it, right? Now it's India specific. The only negative news that FIS had was on the quarterly earnings season and the near-term GDP growth. Otherwise, the budget has been positive. The RBI policy has been positive. The BJP's Delhi win has been positive. So I think India's long-term growth story, barring this flip over a couple of quarters, is strong. So from that point of view, two things. One is that if you see the selling pressure, you're talking about FI selling, but the correction has happened more in mid and small caps. Why is that happening? Because domestic institutional investors are also booking profits in mid and small cap where the valuations have run up a lot. So I would say that the whole DII segment, whether it's mutual fund managers, PMS managers, AIF managers, HNIs, family offices, are actually sitting in a lot of cash. Now these events are past us and it's time that they started deploying, I believe. But like I said, Mr. Modi's visit to US is one final event where if anything positive comes out of that, I would expect DIS to step in and start buying those which have corrected a lot, whether it's across large, mid or small, right? Second is FII.
Right, Mr. Subramaniam, I apologize for cutting you off. It's time to wrap up for the day. Let's bring up the charts and see what the day is looking like. Nifty rather range bound, 0.8% cut. It's not done much over the course of the day other than a 185-point cut coming in. Sensex 2 in tandem with the Nifty, 0.7% cut on that front. Advanced decline ratio very steeply in the favor of the declines today. On the back of that, the India wicks are also spiked up 6%. It's there around the 14.5 mark right now. Let's pull up the broader markets because they are the real losers in today's trading session. Let's pull up the Nifty mid-cap index and see what the cuts are looking like. On that one, you have a 2% cut coming in on Nifty mid-cap, so that has intensified over the course of the day. Nifty small-cap as well, 2.2% cut coming in on that front. Sectorally, very quickly, let's take a look at what the sectors have done. All of them are in the red right now. Least cuts coming in on Nifty Bank, 0.4%, and the most coming in on Nifty Realty. Surprisingly, 3% lower, 3.2. It's even surpassed metals today, which was the biggest loser over the course of the day. 2.7 cut on metals, media, energy, pharma, auto, bank, IT, and FMCG, your most to least sectoral losers in today's trading session. Lots of earnings, lots of order wins coming in, a whole host of stocks that were in focus today. But well, yes, this is what we are wrapping up like for the day. An 0.8% cut coming in on Nifty. We are sub the 23,400 mark for now. Let's hope tomorrow is a better day for us. But on that note, we wrap it up on this edition of Closing Trades. Thank you so much for watching.
I will take you to Paris.
Paris नहीं, Paris. तुम्हारा pronunciation भी ना, तुम्हारे इरादे की तक.
मैडम इरादे कभी ऑफ नहीं होते, टेक ऑफ करते हैं.
SBI Life Smart Platina Supreme के guaranteed returns